In recent years, increasing mobility of capital and companies has led to fierce tax competition and brought down corporate tax rates. For instance, if you look at high-income countries, the median corporate tax rate came down from about 50% in the 80s to less than 30% nowadays. Now, the danger is that if we erect trade barriers between the UK and the EU, that then the UK becomes less attractive as a destination for foreign direct investments. And as a result of that, the UK government might be very much inclined to cut even further these low tax rates to compensate companies for the negative implications of Brexit. Now, we can't expect then that the remaining member states of the European Union stay idle. They would probably follow suit and cut their tax rates as well. So we would be in a further downward spiral when it comes to international tax competition, with all the negative consequences that would bring for public finances, for spending on vital infrastructure, education systems, and so on. The fundamental problem of international tax competition or international taxation is the mismatch between the limited range or reach of national governments and the global activities of multinational enterprises. And the only way to get control over taxing at the international stage is by means of coordination and cooperation between countries within Europe and beyond. If it were to lead to a further race to the bottom with respect to tax rates, certainly that would have negative implications for the budgets on both sides of the channel. It would make further cuts more likely. The alternative obviously would be to increase other taxes on labor income, indirect taxes, or perhaps taxes on small and medium-sized enterprises which are less internationally mobile. So if the aim is to retain companies in the UK, these tax cuts or potential tax cuts could be geared towards multinational companies at the expense of smaller and medium-sized companies, which would shift the tax burden further away from big companies to the smaller ones. A low tax strategy is, at the end of the day, usually only successful for smaller nations such as Ireland or Switzerland or Luxembourg. The problem is that they can benefit much more from undercutting their larger neighbors than larger neighbors could benefit from undercutting smaller neighbors. So the UK, as a country that is relatively large compared to countries such as Ireland, probably can at the end not gain that much from international tax competition. To the extent that these cuts only compensate or mitigate the negative consequences of Brexit, the companies will not overall gain from these tax cuts. What it could do, it could reinforce a shift of the tax burden from large internationally operating enterprises to small and medium-sized enterprises which are not that internationally mobile. So in this sense, there might be rather associated with these tax cuts a shift in the burden at the expense of smaller and medium-sized companies. It can soften the negative implications of Brexit for the wider economy, for the job market, but that might very much depend on the region and the specifics of the regional economy, as well as on how the tax cuts actually would look like. if it were the case that there would be a shift of the tax burden in favor of big internationally operating companies, then you could easily imagine that a region such as the Southwest here, which does not have that many internationally operating companies, but more depends on medium-sized and smaller companies, that they could actually lose out, particularly if the government tries to make up for any falls in tax by higher taxes on other sources. Well, to deal with the potential challenges that Brexit poses, the government should focus on measures that enhance the productivity of the UK company, such as improving infrastructure, improving skills, rather than focusing on tax cuts. Tax cuts are rather kind of a short-term fix, whereas any measures that enhance productivity benefit the economy in the long run. The first recommendation would be to keep a close partnership with the European Union. The closer the partnership, the better the trade agreement, the less likely it is that there are significant negative implications of Brexit, and therefore the less likely it is that we run into a potential further downward spiral in terms of international tax competition. The second recommendation would be to, in any case, to not only cooperate strongly with the European Union on trade issues, but also on wider economic issues, including tax policy and tax initiatives, to exactly avoid the negative implications of a wasteful international tax competition. Importantly, international tax cooperation or coordination does not mean that all countries have the same tax rate. What it is rather about, it is about agreeing on some common rules, perhaps some kind of minimum tax rates, but mainly some common rules that exclude particularly wasteful practices in international taxation. So in this sense, this is kind of a weak cooperation that is not about harmonizing tax rates across a range of very different countries with very particular characteristics.